The numbers on your screen haven't changed much. Corn is still in the same range. Beans still look solid, cattle haven't broken, and if you just glance at the market, you'd think nothing major happened today. But something did. And it's the kind of move that doesn't show up in grain prices right away. Oil just exploded higher, double digits, in one move. When that happens, it doesn't stay in the energy market. It works its way into everything farmers rely on. Fuel, fertilizer, freight, and eventually into decision of what's going in the ground. The problem is the grain markets haven't priced that in yet. So now we've got a situation where the cost side just shifted and the revenue side hasn't caught up. And when that gap shows up, it doesn't sit there very long. So the question right now is, did today just quietly change what farmers are going to plant this year? Welcome to Boots and Bushels, your daily look at the markets that feed America. Here's what we're digging into today. The oil move that could ripple through every acre decision. Why ethanol demand slipping matters more than it looks. Where corn, soybeans, and wheat are actually sitting right now. What livestock markets are signaling about margin pressure. And the weather risks starting to stack up heading into planting. We'll get into the markets here in just a second, but first, you need to understand what this changed underneath them. Let's start with the driver today, because everything else builds off this. Crude oil is trading near 94.50, up over 10%. That is not normal. That's not gradual. That's a shock move. And energy shocks don't stay isolated, they spread. They move through the system faster than most people expect. First into diesel, then into fertilizer production, then into freight and logistics, and eventually into the cost structure of every acre. And there's a timing problem. This didn't happen after planting. It didn't happen mid-season. It happened right before decisions are being finalized. That's what makes this dangerous, because farmers don't react to price charts. They react to margin. And if the cost side just jumped, without the revenue side following, that margin tightens fast. Now let's get into the markets, because this is where the disconnect shows up. Corn is trading near 452, up about 7%. That's steady, but that's the issue. Corn is not reacting to the oil move yet, which means one of two things. Either the energy move fades, or corn hasn't caught up yet. And if it's the second one, that's where things can accelerate. Because if farmers start factoring in higher cost, corn acres become more sensitive, and that's when the market has to adjust. Soybeans near 12.14, up about 1.1%. Beans are quietly stronger here. And this is where the acreage conversation gets real. Because when input costs rise, beans usually gain an edge. Less fertilizer exposure, lower upfront risk, and right now, that difference matters more than usual. So while the market isn't screaming it, beans are starting to look more competitive again. Wheat is near 594, up around 1.5%. Wheat is catching some support, but it's not leading. It's reacting. And it's reacting to global uncertainty, energy strength, and early weather signals. Wheat doesn't need a full story to move, just enough pressure to shift position. Oats are down over 3%, trading near $3.59. This is where you see the separation. Not everything is moving higher, which means this is not a broad buying. This is targeted. And targeted movement usually means the market is positioning ahead of something, not reacting to what already happened. Now let's move into livestock, because this is where margin pressure becomes real fast. Live cattle near $233.28, up about 6%. Still strong, still supported, demand is holding, but the pressure point is coming, and it's feed. Because if corn confirms, or even just holds steady, feed costs stay elevated. And that starts tightening margins, not overnight, but quicker than most expect. Feeders near $355 basically flat, and flat matters. Because feeders are forward-looking, they reflect expectations, not just current conditions. So when feeders stop pushing higher, it's often hesitation, not weakness, but caution. Lean hogs near 93.57, slightly lower. Hogs continue to drift, and this is where cost pressure hits harder. Less margin cushion, more exposure to feed shifts, and more sensitivity to demand changes. So while cattle are holding, hogs are showing you where pressure builds first. Now this is the piece that doesn't get headlines, but matters a lot. Ethanol production dropped sharply, down over 30,000 barrels per day. At the same time, inventories are building. That combination matters, because ethanol is a major demand driver for corn. And when production slows, even slightly, it chips away at that demand base. Not enough to crash the market, but enough to create pressure underneath it. And when that lines up with rising cost risk, it becomes more important. Now let's talk weather, because this is not a clean setup. This is unstable, and unstable weather creates decision pressure. In the high plains, there's strong winds, dry condition, and critical fire risk. This impacts pasture, early grazing, and moisture outlook. And the signal's dryness is still a concern. In the upper Midwest, the cold is hanging on. Late season snow in some areas that delays soil warm-up, early prep, and planting timelines. And delays matter because they compress decisions. In the central U.S., storm systems are building. Potential for severe weather, heavy rainfall in pockets, and this is where volatility comes in. Not perfect conditions, not disaster, just inconsistency. And that's enough to shift behavior. Now bring it all together, because this is where the real story sits. Prices haven't changed dramatically, but the environment around them has. And that's what matters. Because farmers don't plant based on price alone, they plant based on margin. And right now, energy just pushed cost risk higher. Fertilizer risk is back in the conversation. Ethanol demand softened slightly. Weather is unstable. And even though the board looks steady, the decision behind it is changing. The market right now is waiting for confirmation. Not from price, not from behavior. Because once farmers start shifting acres, adjusting inputs, and hedging differently, the market moves, and it moves quickly. The biggest risk right now is not that something breaks today, it's that something builds quietly, and then shows up all at once. Because right now, the market is not fully pricing in energy risk, cost volatility, or behavioral shifts. And when that gap closes, it usually doesn't do it slow. So heading into planting, this is the real question. Did today change the math before the market changed the price? Because if it did, then what looks stable right now might not stay that way for long. Thank you for watching Boots and Bushels, your daily look at the markets that feed America.